This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today, trying to give you all the content so that you can see that there are many tools in the toolbox to play at the highest level. You know, leadership matters at Hedgeye, so again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probabilities. It's not about picking stocks. It's about picking the right portfolio. Execute across everything. Don't get distracted by the MSM and the tourists. They're very dangerous. I will grind and execute for you with our people and with you.
Good morning and welcome to the Macro Show for Tuesday, June 14th. I'm Ryan Ritchie, Junior Macro Analyst here at Hedgeye. I'm joined live in the studio by Hedgeye CEO Keith McCullough. As a reminder, if you have any questions, please put them in the comment section below. We'll do our best to get them at the end. With that, I'll turn it over to you, Keith.
All right, good to see you, Richie.
Good to see you as well.
You get your place in Jonesy again today?
Yeah, I don't know where he is, but
Tan's looking a little better as the summer goes deeper. Here we go.
It just keeps going.
Quad 4 gets better too. All right, top three things in the notebook this morning. This is Richie's first Quad 4, by the way, and he's enjoying it quite thoroughly. Number one is going to be the VIX. Number two, interest rates, and then finally going to hit on energy. First on the VIX. So we have a very interesting setup here. It makes it a little messy, I guess, because you have options expiration for the VIX tomorrow morning before the Fed reports. Whatever they're going to do. And then you have SPY, or the big monthly options expiration, which is, of course, on Friday. Over $3.2 trillion in notional is going to expire, which is, one of the all-time records. So we're seeing record everything, basically, in the options market. Even yesterday, when you look at the notional that traded in terms of S&P 500, I believe yesterday was on S&P 500 puts, it was around $758 billion in notional, which if that sounds high, that is very high. In fact, the second highest of all time, with the largest of all time actually going back on January the 24th. So again, you have more and more why this is happening. Why? It's because more and more people are trying to run money with more and more leverage and less liquidity. I've thought this for a long time, hedge funds in particular that are trying to run neutral with massive amounts of gross exposure and tight or neutral nets. The only way that they can readjust is through the lens of these options. Not the only way, but you see what I'm trying to say. And it's getting bigger and bigger and bigger and more problematic as, of course, the level of volatility continues in the F bucket itself. So again, in the F bucket, don't forget that that's where we're at. VIX closed above 38, or rather 34. I think it's 34.02. It could go to 38 is actually the point. Top end of the range today is just north of 36. But that notwithstanding, anything north of 30, 31 puts you directly in the F bucket, which is where things go straight down. I had a lot of questions yesterday on why XLU and GDX went to neutral. Now GDX is actually bearish trend. It's because we're in the F bucket. That's the simplest answer that you could have. If you need to boil the ocean on a different way to get through it, that's on you. Again, I don't make it that complicated. By the way, on implied, we saw a big drop finally on implied volatility discounts, which had been really just sitting right there. Again, 3 trading days ago, you could have easily shorted everything and done wonderfully in the last couple trading days, and I hope you did. And I hope you have throughout all of Quad 4 now that the S&P is down almost 22% from its January 3rd all-time high. And of course, the Nasdaq's down around 33%. The Russell is down 30% from its cycle high on November the 8th. So again, now we have some implied vol discounts. There's still discounts, by the way, minus 10 on Qs and minus 8 on implied vol versus 30-day. Realize that is for S&P 500. On interest rates, what do? Damn good thing that I did on Thursday, right? I said I'm not going to summit that mountain. 70-mile-an-hour wind yesterday became 80. 81.5 intraday. Now, it got real windy real quick. And again, I did not buy a damn thing. I wrote that down. To those of you that subscribe to Macro Pro, you know what I do intraday in terms of resizing positions. I didn't touch anything other than sell some bonds. So again, selling bonds is what I've continued to do. I got a massive position in cash. Next position on a bounce in bonds, if we stay above the 2018 highs on 10s, will be no bonds, okay? No, I don't have to own anything, right? I don't know. You think I do? You think I need to make the case? Absolutely not. Absolutely not. I'll walk right down that mountain. I'll go from 26,000 feet down to 0. I'll go under the frickin' mountain, man. Yeah, can you do
Orleans?
that? Yeah. But again, now everyone's like, no, I'll do what the market's doing, okay? Because the 30-year yield's below where it was in 2018, so I could tell you that I could do the other thing and go back up the mountain. So again, happy with what I did, and very well aware of what I'm going to do next and why. Okay, so that's what I have to say about interest rates. By the way, what a day! Were you short high yield and junk? Awesome. Look at that fishy.
It's almost complete.
It's You've been waiting for that?
I've been waiting for a long time.
Right? Is there a technical term for that? Le poisson?
It's called short HYG.
Okay, there you go. That's the blue line. And the black line is high yield spreads going towards 500 over. And you know what's going to be really fun? When they cross. That's called, that is going to make le poisson taste wonderful. Look at that. I'm talking to the Italian en français.
En français? Je ne parle pas français.
I can tell. HYG is what it is. The move index, by the way, we should call that out in cross asset class vol. I might as well put that on the board. 139, that'll catch your attention. Again, the process works. You may not execute on it perfectly, and I don't either all the time, but I did pretty damn well this time. Through 111, you're in the wrong spot from a treasury bond vol perspective, and obviously in the right spot from a short J&K jump bonds or high yield bonds or anything for that matter, financials, which is in our top 3 on the sector styles. Point number 3 this morning is energy. Could I buy some? Oh yeah, come on, baby. Gonna buy. I gotta buy because Kramer likes it. Like seriously? I mean, we walked through it yesterday. What would have to break from an immediate term trade perspective on WTI? It didn't. What would have to break from a trend perspective, which is 106? It obviously didn't. Trend on XLE didn't break. There are plenty of other ETFs that the Italian stallion here has been feeding me, just like, I guess that's what they used to say to Zeke Elliott, when he looked like he could run forever. But now he's kind of looks like he's been eating a little bit too much on the eats.
Yep.
Feed me. Now, I got a lot of tickers that we could buy in energy, and I already snuck some in there in the PA on the single stock side. But that notwithstanding, I think energy is a good spot here to buy some today. Again, you got to be very careful of what happens when you're in the F bucket. You obviously saw that yesterday on the bongo board. Again, this is one of the main reasons why I have not been long, at least XLE, is that it's been overowned, it was overbought, it had implied vol discounts. Now some of that's changed a little bit. I mean, obviously it's gone down 10 or 11% in a straight line. XLE was down 5.2% yesterday, which would have just added to any headache you would have had owning anything in equity, and that's what happens when the VIX goes into the F bucket, and those are your top 3 things. All right, predictably irrational. So this morning, I went to the book. I like to go to books that I'm reading. And I said, in reality, I said it because he said it, Dan Ariely said it. In reality, we only think we know what we want. So today, everybody needs and wants 75 and 100 basis points of rate hikes because they think that's going to fix inflation. All the people that need this and want this are the same people that needed you to believe that inflation was transitory last year. So again, it's like bullshit upon bullshit. If you think that raising rates by 250 basis points tomorrow is going to change the CPI number next month, you're literally an idiot, right? That's not going to change it. We walked through it on the call this morning to change a third of the CPI. Don't forget, we're the ones that told you that the shelter component of CPI was going to make the CPI number double and double last year at this time. And again, now we can tell you that number ain't coming down anytime soon, okay? So it's not about raising rates to take down inflation. If you raise rates, you invert the curve further, McFly, okay? So again, we've got a lot of people that are professional, experts, whatever, troubadour. Le troubadour, en français, les raconteurs. I'm going to tell you all about inflation and what the Fed should do. Even Chrome Dome Kramer saying 100 basis points, right? Again, if you are listening to that bullshit throughout the day, you are also predictably irrational. I'm not accusing you of that. Today, we're actually getting a few of you that haven't watched the show before. Would it be nice to have somebody actually deal in real terms? To have skin in the game, a portfolio that they actually execute on every single day for his family? That's what I do. Again, we're not full of bullshit here. We're not telling the Fed to do precisely what they shouldn't do in Quad 4, which is tighten or raise rates more into a slowdown. Now again, yesterday I said that I think this is a bit of a setup. Once you get Goldman and Kramer in the same bed, you know what that is, right? Right? Goldman guy calls a Goldman guy. Get that out there. 75 basis points, 100 basis points. Then the Fed comes in and sneaks one past the goalie. 50. Yeah, markets could rally hard on that. Because the Fed shouldn't be doing 50. They shouldn't be doing any. Got it? That's according to me. And until they stop doing more than expected, the market's just going to get us paid more on the short side. All right? So me, the selfish bastard that I am, staring you right in the eye. I'm telling you, they do what's on the board there, 11 more interest rate hikes, the S&P is not going to be down 22. It's going to be down 32, then 42%. Okay? And for those of you that don't think that can happen, the NASDAQ, as of right now, is down 32.7% from its cycle peak. Again, tightening into quad 4. This has been our call the entire year. It's not a call from the heavens. It's a process-oriented call that I have never had wrong. Ever. In the history of never ever, which is a long time. I said if you tighten into, or you get financial conditions tightening into a quad 4 economic slowdown, you will implode the stock market. You will crash it. Greater than 20% decline. I have 100% batting average on that. Keep it here. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.